Hi, my name is CH. I have worked as a managed investments product specialist in Singapore for over 15 years and would like to offer, through short video courses, the investments related knowledge that I have picked up throughout the years to anyone who is keen to learn more about investments. This video is part of a series of videos focusing on providing basic yet detailed knowledge on mutual funds for Singapore-based or Singapore-booked investors. In this video, we aim to give an overview of what is a mutual fund as well as its key features. So, what is a mutual fund? A mutual fund is a type of investment product that is well regulated in Singapore and most other countries. The regulation is important so as to provide some form of standardization and assurance to investors. Mutual funds come with a clear and predefined investment objective and strategy that it must adhere to. If a mutual fund is defined to invest in US equities, it cannot invest in, for example, Asian bonds. There are a wide variety of mutual funds with different strategies available for investors to pick and choose. Mutual funds are meant to take long market exposures, in contrast to some hedge funds and some derivative ETFs that take short market exposures. The exposures are usually done via direct purchase of equity stocks and bonds, and sometimes, to a lesser extent, done by ETFs, other mutual funds, or derivatives. Mutual funds are meant for mid to long-term investment horizons. By this, we mean usually at least 1 year or longer of investment holding time. Mutual funds are highly liquid, with majority having daily liquidity. This means the fund can be bought and sold on daily basis, making it easy for investors to add or reduce holdings in accordance to market conditions. Mutual funds are actively managed investments. This means there is an investment portfolio manager or several co-managers, as well as their research team, to review and make adjustments to the investments in the fund's portfolio daily to try to generate a good performance. A mutual fund will consolidate all the investors' monies together into a common pool and invest in a portfolio of diversified investments. This means all investors are treated equal in the fund, and each investor basically has a limited part ownership of the same fund. Trading a mutual fund is different from trading stocks and bonds. Mutual funds are typically bought and sold with the fund provider. For most individual investors, this is done by a third-party distributor, for example, a bank, an online investment platform, or an independent financial advisor company. Given the above points, mutual funds can be easily used for asset allocation in an investment portfolio, or to express a specific investment exposure. To put things in better perspective, let's do some simple feature comparisons with mutual funds against single stocks and bonds on one end, as well as against exchange-traded funds or ETFs on the other end. On one end, we can invest in a single stock or bond, which means we are taking a very specific and deliberate direct investment in a company, either via its stock or bond. Returns are directly dependent on that single company's stock or bond price movements, which can potentially be very high if the price movement has significant fluctuations, and this applies on both upside and downside. There is an additional risk of substantial loss if the company defaults. On the other hand, we can invest in a broad market instead, which is comprised of a large number of stocks or bonds, through an ETF that tracks the market index. Going via an ETF also typically means it is a passive investment, as most ETFs tend to just invest as close as possible to the composition of the market index. Returns fluctuation will be lower, as the market's return is the weighted average return of its underlying stocks or bonds, while risk of substantial loss is reduced as well, as a default will impact the overall market return in a small way. Mutual funds sit in between these two ends. As mutual funds have a portfolio of holdings, which means they are more diversified than a single stock or bond, but they are still a subset of the broad market. For example, the leading US market index, S&P 500, has about 500 US stocks, with Apple being one of them. And a US equity mutual fund will typically have about 30 to 50 US stocks. The underlying holdings in a mutual fund portfolio also changes dynamically, as the fund manager will actively adjust the portfolio in attempt to deliver a better performance than the market. As such, for the same category of exposure, the returns and risk expectations of a mutual fund should also be in between a single stock or bond and a market ETF. To put this in a non-investment context, we can imagine this as shopping at a fruit store. If we know we want exactly just oranges, we can buy a specific single fruit. Or, if we are indecisive, we can get one of each fruit from everything that is available in the fruit store. Although that can be expensive, and we will probably get a mixed satisfaction eating all the different fruits. Or, we can pick a few of our favorite fruits, for example, oranges and apples and watermelon, to get our preferred mix of fruits and nutrition, which would normally be more satisfactory than trying to eat everything. Other key considerations when comparing the three types of investments include fees, investment amount, tradability, and liquidity. For transaction fees, banks and trading platforms typically charge for all three types of investments a buy transaction fee per trade, and sometimes charge a sell transaction fee. Mutual funds and ETFs also embed an ongoing management fee within their quoted price, or NAV. Some mutual funds also have an ongoing performance fee embedded that is subject to the performance of the fund. Generally, mutual funds require more resources and effort to actively manage, and thus their fees are slightly higher than ETF fees. Investors would therefore also expect mutual funds to have better performance than ETFs for similar market exposures. Investment amounts for stocks are dependent on the individual stock prices, while for bonds, they typically exist in around $200,000 notional values to trade, and therefore may not be suitable for investors with smaller investment amounts to deploy. ETFs generally have low investment amount requirements, with $1,000 or less, while mutual funds come with different share classes and different investment amount requirements, with most funds having retail share classes of around $1,000 requirements. On tradability and liquidity, stocks are listed and traded on exchanges, while bonds are usually traded over the counter. They are tradable intraday, and therefore their prices can fluctuate throughout the day. They are also subject to market liquidity, meaning that you can only buy a stock or bond if there is another party that is willing to sell it. ETFs are also listed and traded on exchanges like stocks. However, the ETF providers can create liquidity by creating new shares if the market liquidity is insufficient to fulfill a trade. Mutual funds, on the other hand, are different in this aspect, as mutual funds are traded direct with the fund provider who ensures the liquidity. Trading is typically done once daily, meaning all orders are consolidated through the day and processed only after the cut-off time of the day, and as well as subject to just one price for that day. To further highlight the key features of mutual funds, let's compare mutual funds to the famous Warren Buffett's company, Berkshire Hathaway. Similar to a mutual fund, Berkshire Hathaway is an investment company that invests in a wide variety of companies, from insurance to candies to infrastructure to technology to banks and more. There is obviously a strategy for what they invest in, which can perhaps be broadly termed as US-focused global equity value style strategy. Similar to a mutual fund, Mr. Buffett has a large team of investment managers and research professionals to study and analyze companies that they own, as well as others that they might be interested in. These resources help to actively manage the holdings in the portfolio, and therefore there are costs involved to keep these professionals. In Berkshire Hathaway as a company, this is reported as wages expenses. In a mutual fund, this is summarized as management fees. As mentioned, Berkshire Hathaway runs an active investment strategy. While it focuses on US equity markets, it obviously does not invest in all US companies, but instead attempts to pick and choose companies with better upside potential than the average in order to try to outperform the US markets. A mutual fund behaves in the same way by investing in a smaller, more focused portfolio of holdings compared to its benchmark, in attempt to deliver outperformance as well. Last but not least, every investor that buys a share of Berkshire Hathaway is effectively a limited shareholder of the company. Each investor is exposed to the same portfolio of investments of Berkshire Hathaway in both risk and return perspectives. Similarly, all investors of a mutual fund is considered a limited shareholder of that fund and is exposed to the same consolidated portfolio of underlying investments of the fund. Now, while those are similar aspects, Berkshire Hathaway is not a mutual fund, so there are some clear differences. Berkshire Hathaway exists as a stock that is listed in the US exchange for trading. Therefore, from a legal and regulatory structure perspective, it is not registered as a mutual fund. Berkshire Hathaway holds a wide mix of company investments, of which some are not listed and fully owned by Berkshire Hathaway with no intention to sell. A mutual fund firstly should invest only in public listed investments, and secondly, should not have any perpetually held investments. As a listed stock, Berkshire Hathaway's shares are therefore limited in amount. Mutual funds hypothetically has no restriction in the number of shares, as the fund provider can create or remove shares depending on the subscription and redemption flows. Last but not least, Berkshire Hathaway is well known to hold cash in its portfolio during times of expensive market conditions. Mutual funds, on the other hand, are meant to stay fully invested and are allowed to hold only a small amount in cash for transaction liquidity purposes. Hopefully with these comparisons, you have a better overview of what mutual funds are and understand more about their key features. This concludes this video. Do check out my other videos to find out and learn more about mutual funds. If you find this video useful and would like to see more related contents, please click on like and subscribe to the channel, as well as share this video to someone else that might find this useful too. Last but not least, if you spot any mistakes or inaccurate information in this video, or have any suggestions to help improve this video, please do drop a comment below. Thank you and have a great day.